Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. This is a week ending report for the weekend starting March 27th. I'm going to take a technical look at the euro versus US dollar, ending the week higher, but in a neutral area technically. What do I mean by that? Well, let's take a look at the week of trading here for the euro versus US dollar. This is an hourly chart. And if you look at last Friday's closing level, it came in around the 108.20 level. Now, it traded below that 108.20 level on Monday, and again, a little bit on Friday. But for the most part, most of the activity was traded above that level. So a little bit more of a bullish tone for the euro as we end the week. Now, in that move to the upside, however, it was choppy type of trading in this week. And our high price, which occurred on Thursday, took out the high price from the FOMC spike, but only by a few pips. And when the market failed to move further to the upside with further momentum breaking out of that high, the buyers turned into sellers, and we saw the big sharp move on Thursday and again on Friday. Now, that move to the downside took the price below trend line, took the price below this 100-hour moving average, and stalled right here against this green line. What's the significance of that? That green line is a 200-hour moving average, and that's going to be our first key technical level on the downside in trading next week. As long as we stay above that, that's going to be more bullish. If we move below it, it's going to be more bearish. Pretty simple, right? So with the market trading up here, we're right now a little bit more bullish for the currency pair. But there is a little bit of a ceiling up here against what is another moving average, and that is the 100-hour moving average. The blue line represents the 100-hour moving average. And in trading today, in the afternoon trading, we squeezed a little bit above that level, but that was short-lived, and the market rotated back to the downside. You can in fact see how the next hourly bar we held resistance against that ceiling. So just as good as a support level it is against the 200-hour moving average, I got to give the 100-hour moving average kudos for being a good resistance level on the top side. So in trading next week, what are we going to look for? We're going to look for either a break to the upside here or a break to the downside below the 200-hour moving average. And that's going to be our parameters for bullish or bearish in trading next week as the market figures out which way it wants to go. On the top side, we have other resistance levels against our high prices through here. And then we're going to have resistance against the underside of the trend line here, somewhere around the 111 level by the time the market opens up on Monday. And what's the significance of the 111 level? There is another significance off of the daily chart. And so if I go to the daily chart and I take a look at the low price going back to January of this year, that low price came in at 110.97. This was a swing low. The market corrected to the upside and then fell below that level through here and gathered some momentum to the downside. So the 110.97, let's call it 111 level, is going to be another key target if the bias continues to move to the upside. If we get above that 100-hour moving average on the top side and those highs that we saw in trading this week. So keep that level in mind on the top side. On the downside, if we move below the 200-hour moving average, I want you to focus here on this 107.59 to 68 level. And the significance of this is twofold. One, it was our low price on Monday. That was at the 68 level. And the 59 level, if I go to the monthly chart and I take a look at the low price going back to September of 2003, that's this point right here. That level came in at the 107.59 level. So it's not a wonder that we found support buyers against that level on Monday's trade and moved higher. They're simply defining risk and limiting risk against that level. Now, that's the picture from a technical level. Get below the 200, get below this 107.59, more bearish. Move above the 100, move above our high prices right here and above the 111 level, and that's more bullish on the top side. What about from a fundamental perspective? We do have CPI data coming out of the Eurozone on Monday the 30th, and that's out of the Eurozone and Germany. We do also have the month end on Tuesday. That would be the 31st of March. That's the month end and also the year end for Japan. So those are factors that could cause liquidity and choppy trading conditions. So be aware of that. It's not going to be an easy trade week. On Wednesday, we have the ADP employment report coming out, and this is going to be our first look at what the trend looks like for the U.S. employment for the current month. And then we ended on Friday with the U.S. employment report. That day is also Good Friday, folks, and that's a big holiday in the European, and I believe the stock market's closed in the U.S. as well. So not only do we're going to have the unemployment report, which is always important in the United States, but it's going to be a holiday for a lot of traders. So we could have some choppy trading conditions and illiquid trading conditions as well, which you have to be aware of as a trader. So anyway, we have the plan set from a technical perspective. We know what we have to prepare for from a fundamental perspective. It's now up to you to define your risk, limit your risk, trade against those key levels, and hopefully it'll work your way. My name is Greg Michalowski. Good fortune with your trading, and have a great weekend. Bye-bye now.